A $500,000 home is not a feeling. It is a calculation. It demands three inputs: cash for the down payment, income high enough to pass the lender's debt ratios, and a debt profile clean enough to survive those ratios while carrying everything else most American households already owe. We are going to solve this in 5 steps, using the exact same variables your lender plugs into their underwriting software: the qualifying rate, the front-end debt-to-income ratio, the back-end debt-to-income ratio, the down payment, monthly carrying costs, including property tax, insurance, and PMI if applicable. At the end of the 5 steps, we will have a single income threshold. Then we hold that threshold against the actual income distribution of American households. The result is a percentage. That percentage is the answer to the title of this video. Everything before it is the proof. We start with the down payment. The U.S. has no tiered minimum down payment system the way Canada does, but the path you take determines almost everything that follows. On a conventional loan, the minimum down payment is 3%. On a $500,000 home, that is $15,000. But at anything below 20% down, the lender requires private mortgage insurance. PMI on a conventional loan typically runs between $30 and $70 per year for every $100,000 borrowed, depending on your credit score. On a $500,000 purchase with 3% down, you are borrowing $485,000. At a mid-range PMI rate of $50 per $100,000, that adds roughly $242 per month to your carrying costs. The 20% down payment on a $500,000 home is $100,000. At that level, no PMI applies. The mortgage stays clean. We are going to run the primary calculation using 20% down because it isolates the income question cleanly. We will return to the minimum down payment scenario afterward. The down payment is $100,000. The mortgage principal is $400,000. This is the amount the lender advances. It is the amount against which all monthly servicing is calculated. No PMI applies. We amortize over 30 years. That is 360 monthly payments. The 30-year fixed is the standard instrument for the American homebuyer and the benchmark every lender uses when running approval ratios. Now, the rate. As of May 2026, the average 30-year fixed mortgage rate sits between 6.37 and 6.46%. We will use 6.4% as our working rate. That is the rate the borrower actually pays. The U.S. does not operate a formal stress test the way Canada does under OSFI. American lenders qualify borrowers at the actual contract rate, not at a buffer above it. This is an important structural difference. It means American qualification math is more straightforward, but also more exposed to rate shock at renewal. At 6.4% on a $400,000 principal over 360 months, the monthly principal and interest payment comes to approximately $2,501. Monthly principal and interest is $2,501. Now we layer in the carrying costs the lender includes in the front-end ratio. Property tax on a $500,000 home varies significantly by state and county. The national effective property tax rate on owner-occupied homes runs approximately 1.1% of assessed value annually according to Tax Foundation data. On a $500,000 assessment, that produces $5,500 per year, or $458 per month. Homeowners insurance on a $500,000 home runs approximately $150 to $200 per month nationally. We will use $175 as our midpoint estimate. We add it up. Monthly principal and interest, $2,501. Monthly property tax, $458. Monthly homeowners insurance, $175. Total monthly housing cost, $3,134. Annualized, that is $37,608. Now we apply the front-end ratio. Conventional loan guidelines cap total monthly housing costs at 28% of gross monthly income. This is the standard the GSEs, Fannie Mae and Freddie Mac, apply to conforming loans. Some lenders allow up to 31% with compensating factors. We use the standard 28% threshold. Divide $37,608 by 0.28. The result is $134,314. We round for clarity. The minimum gross household income required to pass the front-end ratio on a $500,000 home with 20% down is $134,000.
Now, we cross-check against the back-end ratio. The back-end ratio caps all monthly debt obligations, housing costs plus every other recurring payment at 36% for conventional loans under standard guidelines. Fannie Mae's automated underwriting system will approve up to 45 or even 50% with strong compensating factors like significant cash reserves or a high credit score. We use 36% as the standard threshold because it represents what most borrowers without exceptional profiles will face.
Most American households carry non-housing debt. We will model a household with $950 per month in non-housing obligations, a car payment of $550, a student loan at $250, a credit card minimum at $150. These are not aggressive figures. They are conservative representations of normal American consumer behavior. The Federal Reserve's 2025 Survey of Consumer Finances found the median American household carries approximately $6,000 in credit card debt. Student loan balances among borrowing households average over $37,000. Vehicle loan balances average around $20,000. Total monthly debt service becomes $3,134 plus $950. That is $4,084 per month, or $49,008 per year. Divide by 0.36. The required gross household income rises to $136,133. We carry both numbers forward. The clean baseline is $134,000. The debt-adjusted threshold with typical American consumer obligations is $136,000. The gap is narrower than Canada's equivalent calculation because the U.S. back-end ratio is less punishing than Canada's TDS ratio, but the direction is the same. Now we hold those numbers against the population. The Census Bureau's most recent current population survey reports median household income in the United States was $83,730 in 2024. Projecting forward at the Federal Reserve Bank of Minneapolis's estimated income growth rate of approximately 2.8 to 3% annually, the 2026 median household income sits in the range of $88,000 to $90,000. We will use $89,000 as our working estimate.
Our clean baseline threshold is $134,000. The median American household earns $89,000. The median household falls $45,000 short. That means more than half the country cannot qualify for a $500,000 home on income alone, even with $100,000 saved for a down payment, even with zero consumer debt, even with a perfect credit score. We sharpen this further. Income distributions are right-skewed. The density above the median thins gradually. Based on Census Bureau income quintile data, approximately 30 to 32% of American households report gross income above $130,000. For the debt-adjusted threshold of $136,000, the share narrows further to roughly 28 to 30%. Using the midpoint of those ranges, approximately 29% of American households earn enough to qualify for a $500,000 mortgage with 20% down and average consumer debt. Roughly 71% do not. Now we break it by state because the national figure hides enormous variation. Maryland has the highest median household income of any state at approximately $108,000, according to Census ACS estimates.
New Jersey follows at roughly $106,000. Massachusetts and Connecticut sit near $101,000 and $95,000 respectively. Even Maryland's median, the highest in the country, falls $26,000 below our clean threshold. In every state in America, the median household cannot qualify for a $500,000 mortgage on income alone. California's median sits near $91,000. Texas is approximately $74,000. Florida is roughly $72,000. These are states where $500,000 buys a modest home in most metro areas, or nothing at all in cities like San Francisco, Los Angeles, or Miami. The income required to qualify for the home exceeds the median household income by factors that range from 50 to 80% in high-cost metros. Mississippi has the lowest state median income at approximately $52,000, a full $82,000 below the qualification threshold. A median Mississippi household would need to more than double its income to qualify. West Virginia and Arkansas sit near $57,000 and $58,000 respectively. In these states, a $500,000 home represents a price point that exists mostly in resort areas or expensive suburban clusters. The households in those states who might want those homes are not the households who can qualify for them. We should note what this calculation excludes. It does not include closing costs. On a $500,000 purchase, buyer closing costs typically run 2 to 5% of the purchase price. That is $10,000 to $25,000 on top of the $100,000 down payment. It does not include the cost of maintaining a $500,000 home. The Harvard Joint Center for Housing Studies estimates annual maintenance costs at 1 to 2% of home value. On a $500,000 home, that is $5,000 to $10,000 per year in costs the DTI formula never sees. It does not account for the minimum down payment path. If the borrower puts down 3% instead of 20%, the mortgage principal climbs to $485,000. PMI adds approximately $242 per month. The monthly housing cost rises to roughly $3,500. The required income under the front-end ratio climbs above $150,000. That threshold excludes approximately 80% of American households. One more variable we have not addressed: the $100,000 itself. At the 2026 median household income of $89,000, after-tax income runs approximately $72,000 to $76,000, depending on state and household structure. If a household saves 10% of its after-tax income each year, an aggressive rate by American standards, where the personal savings rate has averaged closer to 5% since 2023, it accumulates approximately $7,400 annually. At that pace, saving $100,000 for a down payment takes more than 13 years. Assuming zero investment return, no emergencies, no medical bills, no job gaps. Many of the households that clear the income bar cannot clear the savings bar. The qualification hurdle is not one number, but two, and they compound each other. Approximately 29% of American households earn enough gross income to qualify for a $500,000 mortgage with 20% down and average consumer debt. Of those, a smaller fraction has $100,000 in liquid savings available for deployment. In 2019, the income required to qualify for the median-priced American home was approximately $49,000. The median home price then was around $258,000. Today, the median new home price sits near $414,000 according to Census Bureau data, and the income required to qualify at current rates is over $106,000 according to SSH.com's salary calculator. American household incomes have not doubled since 2019. That is not an opinion. That is the math.